welcome. We're so delighted that you're here. We appreciate you being here. There is much I would say to you by the way of pleasantries, but I want to be respectful of your time, and so we're going to dive right in. We're going to get busy. So let's set the context. Here we are in a moment of time that is tense. I think that's fair to say. It's characterized by political upheaval. It's characterized by market volatility. It's characterized by punishing rates, international conditions, stiff headwinds. And this valley is operating in that kind of environment, and we've entered into a period of slower growth. Not normally how we roll here in Silicon Valley, and yet we've entered into that kind of a period, and so we're going to start unpacking that today, and I'd like to start talking about it first in terms of our employment picture. Here is what I think we should understand. Our workforce is 1.7 million people. We have 3 million people living in Silicon Valley as we define it. 1.7 of those are full-time participants in the economy that we create here. That's your number, 1.7 million. Now, here's what's interesting. That number has stayed fixed. Here it is year by year. You're looking at the total number of jobs. And we've been at 1.7 million since 2019. Right before the pandemic set in, that was us, 1.7 million. We had the upheaval of the pandemic, and we all experienced that. And then we had returned to 1.7 million. And the thinking was that that would be the launch pad for our continued growth. Instead, what's happening is this. We've plateaued right there. We're not growing. We're not shrinking either. We need to understand that. We're just staying in place. That's how we should understand the economy. Now, I always like to make sure that you have the big picture on our history and how we ordinarily characterize things here. So take a look. This is us going way back to the dot-com, all the dot-com craziness at the turn of the century, and we had just exploded in jobs, and then that all came crashing down, and many of us lived through that. We resumed growth. The growth then was intercepted by the epic recession, and so that's what you're looking there, when, again, we had the cratering. This region, however, was the first to emerge out of that epic recession, and now we're talking about recent history. At that point, starting in 2010, we entered a period of sustained growth every year. We were adding 50, 60, 80,000 people to the economy. And we sustained that for a period of 12 years, going straight into the pandemic. Then, another amazing thing happened. We thought that the pandemic would be a death knell to this region. It turned out to be the opposite. Certainly in terms of our driving industries. It turned out to be a bonanza for those companies that were providing the goods, the services, the equipment, the platforms that the world so badly needed in that moment. And so our job growth continued, though we had shifted. And the structure of our economy changed, but we actually grew through the pandemic until August of 22. And that's when we entered a new chapter. That was when folks in our driving industries decided that there had been some over-hiring during the pandemic, and we needed to enter a period of recalibration. And so we've been going through that for a period of time, and there you see it. We've had that explosive growth in our driving industry since 2010, but since 2019, year over year, just growing a little bit, shrinking a little bit. It's staying steady in that way. But you're saying, now wait a minute. What about the layoffs? How should we understand that? And what is the effect that that's having on our overall employment? Yes, the tech sector is laying off. It began as what I mentioned, recalibration. The sector just overhired and needed to level set once again, and so that happened. Then we entered a second chapter. The second chapter is what I'm characterizing as a push for efficiency. We used to be a valley of exuberance and a valley of massive investing, and the mantra was that you should scale, and you should scale quickly, and our companies were creating plants and environments and campuses that were filled with amenities. And about midway through 2022, a new dynamic set in where it was important to be efficient, important to be using fiscal restraint, and that included a round of layoffs. And those have been happening, and they are continuing to happen. So we need to understand the impact that they're having on the overall economy. That is the absolute number. Since August of 22, there have been 66,000 layoffs in the tech companies, layoffs in other sectors as well, but we're talking about our driving industries, the technology companies, and they've shed about 66,000 jobs. And the narrative that we're hearing as we read the papers is that those are significant numbers, and they are. They absolutely are. And that's a big number. However, we need to understand it in context. So let me help you understand that number, 66,000, as a percentage of our total workforce. Remember, 1.7 million in the workforce. So what we're talking about is a 3%, round up to 4%. We've actually shed about 4% of our workforce over that period of time since August of 22. If you were to understand it as a percentage of the tech workforce, then what we're talking about is around 11%. Now, again, not nothing. That's not nothing. But we should understand that those are small, single-digit percentages of the overall. And remember, when we were way back here, this is nothing like the hundreds of thousands of jobs that we lost after the dot-com crash or that we lost after the epic recession. So we need to understand it in that context. We need to understand them contextually. Now, here's another interesting thing about the region. Those 66,000 layoffs have, for the most part, been reabsorbed. How do we know that? We know that because our unemployment rate has stayed fixed. We are in the threes. It's gone up to 3.9. It's come down to 3.1. At one point, during the earlier phase, we were in the twos. Economists will tell you that anything in the 3% range is considered the equivalent of full employment. And so that's actually what's been going on despite the layoffs. So what that means is that people are landing on their feet. They're reintegrating into other tech companies, into the startup environment, or pursuing tech careers in the other sectors like fintech, like ed tech, or ag tech, or ed tech, all of those things happening. And so somehow, you remember, you saw that chart where it was flat, despite the layoffs, we're where we were. And we are and we seem to be continuing in that way. So you could say that that is a signal of how robust this economy is, that it can even absorb a round of layoffs at that scale. That's one way of looking at the economy. Now, I told you that the new mantra and the new strategy is efficiency. That strategy is paying off. It's paying off very, very handsomely. And as you look at our companies, any way you measure it, market share, revenue, stock market performance, or this one, look at this. This is extraordinary. This is the regional market cap. Remember, market cap is the value of all of the publicly traded companies, and they're blowing through the roof. We've hit 25 trillion. 25 trillion is the value of Silicon Valley's market cap. That's a record-breaking number. We've never seen anything like that in our history. So one message we want you to have today is that the Silicon Valley economy and ecosystem is rife with contradiction. Yes, on the one hand, structural changes. Yes, on the one hand, being battered by external forces. Yes, layoffs happening. Yet on the other hand, absorption and opportunity still being created, and record-breaking profitability. So there you have it. That's what can you say? We contradict ourselves. That's the best way to understand it. Now, you may be curious about tech and its proportion of our workforce. So let me just tell you that tech takes up about 25% of our workforce. That's the black square that you see on the slide. And then the rest of our workforce are doing what I call jobs of place, the kinds of jobs that you would find in any economy. anywhere across the planet. These are what we call community infrastructure jobs. They include construction, retail, healthcare, education, all of those jobs. And the reason I'm showing you this chart is because you should know that also during that period where we were making up ground and experiencing absorption, we are seeing growth in this sector as well. So there's been a steady state in the tech sector, remaining at about 25% of the workforce, but the other jobs also growing, in this case by about 2-3 percentage points. So on the one hand, you could argue that we continue to be a pretty healthy economy. However, now you're going to tell me, but what about the exodus? There's been a mass exodus out of our region. And how do we understand that in context? Well, I would like to put that in a bigger context for you. There are a couple of ways that we should look at this. I think the best way to look at it is as a population trend. And our population is shrinking. But population has many components. And let me lay them out for you. One would be the birth rate. And this is Silicon Valley's birth rate over a 30-year period. And guess what? Our birth rates are declining significantly. 34% decline in the number of births in Silicon Valley. So that's one factor that we need to understand about our population and those trends. Okay, another factor that we need to understand. We're an aging population. Look at us. The percentage of our population that is above the age of 65 has grown by almost 30% over that same period. Okay, so you have to put those two factors together, and this is how you do it. This is how you look at population change in the normal, straightforward way, which is births minus deaths. And if you look at it that way, you can see that our population is declining steadily over time. Now, there's another dimension to our population change, and that would be the influx of migrants. There's the influx of domestic migration. There's also the influx of international immigration into our economy, and that's been a big part of our story. So here's a chart that's showing you the net migration, and here's a chart that puts it all together for you. We've got our net domestic migration. In other words, we're charting if people came or if they left, and we have the net foreign immigration, if they came or if they left, and then the green line is explaining to you what the trend was when you factor it all together. And so here we are. I should remind you really quickly, we should never forget this. Silicon Valley was not built merely by Californians or by Americans, for that matter. Silicon Valley was built by the best and the brightest coming from every continent around the world, and that has been our history. And so here you see those trends as the immigration it ebbs and flows, but we were on this terrific tear, which came to an abrupt halt in 2016, and it corresponds. There's a perfect correspondence to the inhabitant of the White House at that period of time, and a new tenor, a new tone was set, and we're still working through the ramifications of that policy regime and that policy climate. Okay, so those are some of the factors that we need to take into account as we think about our population and its trends. And then finally, we did experience, for a 2-year period, a massive outflow of residents. And that was the total number. So between 2020 and 2021, we did see the departure of about 44,000 people from the region. That's not nothing. That's a significant number. But when you put it in the broader context, again, you understand that that's not the only thing going on. And when you compare it to these other demographics, that number is not as big as people might have thought. Also, interestingly, we know that a significant percentage of those who departed were actually still filling Silicon Valley jobs. When you put all of this together, that's what we're talking about. Our population has declined by about 134,000 people since 2016. So that's what's going on. So that's about 1 in 20, okay? And that probably matches your experience. I think about mine. At least 1 in 20 of my friends in social network have left the region. That's for sure going on and will probably continue. By the way, we're not done with this. We take a poll every fall, and the result of the poll was that of all residents, 47% say that they are seriously considering plans to leave the region. We could do a Slido poll on that question and see how this room feels about that. That's possible. Now, some further context on the people who are departing our region. We got some granularity for you. We were interested to discover that 25% of those who were departing stayed in the Bay Area. They didn't leave. They moved to the perimeter of the Bay Area. They moved just adjacent to the Bay Area. In fact, the largest numbers moved to Alameda County and the further flung communities in Alameda County. Why? You know the answer. Housing is more affordable in those places. And so 25% are still here, literally here. The next 25% went to Northern California. I like to refer to that as Greater Silicon Valley. That's what's happening. And again, makes sense, because remember, you're holding on to that Silicon Valley job, but now you can have a very affordable home in a lovely community like Folsom and in Sacramento. And then if your employer says, well, I want you in the office 2 days a week, no problem. You drive back. You sleep on somebody's couch. There's a lot of couch surfing going on. And that's how people are rolling. So 50% of the departures still fully integrated with this ecosystem that we've created here. Now the rest, you may wonder where they're going. I was surprised to learn that they're going to Seattle. That's a big destination. And then, yes, they're going to Austin, Texas. We hear about that, and they have a significant growth rate. And Boston is a popular area, and so is Portland and Denver. That seems to be where people are going. Okay, so we're talking about people departing the region. I think an equally important question is, are companies leaving the region? That would be significant, because remember, companies create jobs, companies create those opportunities. Since the pandemic, here's the number. Grand total of 4 companies have left the region. And you know who they are. It's these 4 companies. Our conclusion is that 4 doesn't make a trend. 4 actually is not a significant number in the big scheme of things. And it's also striking to us that of those 4, 3 have CEOs that have points of view and personal circumstances that it made sense for them to relocate. And they just weren't feeling the vibe here. That's what I'm getting at. But what is striking about those who departed is that they left the company behind. And make no mistake about that. Tesla is one perfectly good example. Yes, the headquarters moved to Texas, but at that very same time, Tesla expanded its footprint in Silicon Valley, built research facilities, built production facilities, built administrative facilities. It's a very small number of people that are actually working at Tesla in Texas, and that is also the case with HP Enterprise and also the case with Oracle. So we also need to understand it in that context. Now, here's the next thing that I think is important for us to understand. Silicon Valley companies are here, they're growing. However, these companies are also multinational. They operate in every state, they operate on every continent. And we should be mindful that they're growing in all of those places. And we've also learned that Silicon Valley companies are growing more outside the region, and they're growing less inside the region. And again, there are obvious explanations. The most obvious is housing. Silicon Valley is a very high-cost region, high cost across the board, but especially with housing. And so it doesn't make sense always to locate workforce here the way we used to do. But it also doesn't make sense, just to be clear, to have all of your workforce here when you're serving international markets and when you need to be using global supply chains and global distribution models. So we should understand that companies are growing here, but they're also growing elsewhere. Now, this is a chart that is explaining to you the percentage of the Silicon Valley share. So take the tech companies. This is our top 20 tech companies. And in 2019, 28% of their workforce was here in Silicon Valley. Today, 24% is here. and they've also added to these other regions. And then those are the percentages for the global as well. In other words, growing here, remember, still growing here, but growing in other places. It raises an interesting question. Silicon Valley, the meaning of Silicon Valley may change. Silicon Valley is a place, it's a place that we call home. But the funny thing is you can never see the word Silicon Valley on a map. Nobody knows where Silicon Valley is. Let's be frank, Silicon Valley is also a phenomenon, and it's a brand name that we use to describe the phenomenon. And what is that phenomenon? It's innovation, and it's entrepreneurship. And it's possible to do those things anywhere on the planet. And it's possible to do those things in a way that's connected to teams and other innovators and other visionaries using the tools that we invented. And so Silicon Valley may come to be seen as not only a localized phenomenon, but also a distributed phenomenon, a distributed approach to innovation and entrepreneurship. And I think we're seeing the early signs of that. This, by the way, shows you the change in employment, again, those same top 20. And so there's the purple bar, that's Silicon Valley's growth. So we've grown 5-6%, growing again, but growing more in Seattle, those same companies. They're growing more in Austin and shrinking in some other areas. We should be mindful of that as well. So that's how we have to understand it. Now, you're wondering, okay, but then where do we really stand? Are we still a global leader? And lots of people are always trying to measure this. There's surveys that come up from time to time. We think this is the best way to measure this. This chart is actually showing you three things at once. Across the bottom axis, it's charting the growth rate, the rate at which your economy is growing with tech workers. Are they becoming an increasing percentage of your workforce? So that's what we're charting, the growth rate. The vertical axis is charting the absolute number of people in your economy that are tech workers, and then the size of your bubble. The size of your bubble is the total number of jobs, I beg your pardon, and the vertical axis is the share that represents. So on this chart, you would want to be the biggest bubble, and you would want to be up and to the right. That's where you want to be, and sure enough, that's where we are. That's exactly where we are, and where we've been for decades, and where we continue to stay, although everything is dynamic, and this is something that we'll continue to watch. The next big question that I think we should take on is all of those things, notwithstanding, all of the trends that I mentioned, population, investment, overseas, all of those things. Set that aside and let's ask this question. Is Silicon Valley still an innovative place? Is Silicon Valley an entrepreneurial place? Or is the innovation engine still firing? We need to ask that question. So in the index, we try to measure those things as best we possibly can, and we're always looking for the objective indicators. How innovative are we? How entrepreneurial are we? Well, this is very objective. There is the number of patents that are coming out of our region. Those patents hit last year the highest number ever recorded, 23,600 odd patents, a remarkable number. That's stunning. You won't see that in any other place on the planet. This is a list of the top 10 patent-generating cities in the United States. 6 out of the 10 are Silicon Valley cities, no surprise. This was interesting. San Jose has been number 1 for 20 years, number 1 on that list. Got bumped off, got bumped to number 2 by San Diego. San Diego is also an innovative place, and for the most part in biotech, pharmaceuticals, that type of thing. I love this chart. We love putting in good news charts. This is the share of patents that had at least one woman inventor. And look at us at 31%. Yes, thank you. That's nice. There are other charts that don't have news nearly as good or robust as that. Let's talk about venture capital. We think venture capital is a very telling indicator. It's not the only indicator, but it is telling you what people are thinking and the kind of bets that they're making. And so here we are. Now, in 2021, in the heat of the pandemic, we saw the most venture capital that we had ever generated in our history. It was staggering. It was $90 billion generated in our region. Wow, that was stunning. And then we didn't sustain it. So the next year, reporters and others said, well, gosh, there's something wrong with Silicon Valley. I would like to suggest that actually 21 was just an outlier. That's an outlier. We'll get expert opinion on this in a minute. But I think if you throw 21 out of the chart, then what you'll see is the real story with Silicon Valley, which is steady, increasing levels of investment as we go along. And I want to point out that the number this year is $70 billion. $70 billion. So just shy of the record. And by the way, double what it was last year. So people are still generating funds, and people are still leveraging those funds on companies that they think are doing promising things and changing the world. By the way, these are totals. These totals include San Francisco and Silicon Valley. And the two places keep trading places. Sometimes Silicon Valley has more, sometimes San Francisco has more, but clearly together, taken together as one macro economy, that's what we're doing, and we're doing it at scale. This is the share. We command 81% of California's venture capital. We command 52% of the nation's venture capital, and that's the highest number that we've ever recorded. So again, robust. These are all robust pictures. You should take note that most of the investment, in fact, I think about 70% or more of those investments are in mega deals. A mega deal is a deal that was more than $100 million. Back in the 70s, 80s, 90s, when venture capitalists deployed their funds, they would spread it more thinly. We can talk about this as well with our expert, but they would spread it over the entire landscape, sort of like spreading fertilizer over your yard. Now they're taking a different approach, clearly. Now it's these massive investments to a smaller number of players. And there's a lot of discipline setting in with the strings attached to those investments. You should also know that angel investing, alive and well, $1.5 billion generated in that format here in the region. And so that leads us to the next very important question. What does the startup activity look like? Well, it's robust. We are generating new startups, and we continue to do it at high rates. It's also interesting to see the funding picture to those startups, and then to understand as well the employment picture. So employment in the startup environment is growing by close to 10%. And these are the fastest growing startups, internets, biotechnology startups, those are the ones. So that's where our high growth is. Remember, we showed you the layoffs. This is where some of that absorption is happening. We should also understand that this region has the highest concentration of unicorns. You know what those are? Those are privately held companies that are valued at more than $100 billion. And we have about 227 of those right here in the region. Extraordinary. No other place on the planet can make a claim like that. We've stopped using the term because we don't think it's any longer perfectly apt. So now we're using a term called decacorns. Those are $10 billion privately valued companies. Anyway, it's an extraordinary concentration. And sometimes we lose unicorns. Do you know why? Because they go public, and then they fall off this list. And their public liquidity events, also extraordinary. So we're pretty gangbuster. This shows you their valuations, and we have to measure it in the trillions of dollars, and it's climbing. So again, we're painting, in terms of the innovation engine, we're painting a picture of robust. 9 IPOs last year. That's not a big number for us. It's not our smallest either. It's just there. Now, a question I think a lot of you have is artificial intelligence. One question is it real or is it just hype? And we won't endeavor to answer that question today. We don't have objective information about that question. But what we can tell you is that it is suffusing the economy and is suffusing all of the sectors. I suspect it's going to be a thing like the iPhone was or like the calculator was. It just gets out there in everything, and it just becomes a part of the fabric or a part of the landscape or part of the furniture, and we won't even hardly think about it. In a period of time, we'll just be using it. That seems to be the direction we're going, but I'm asking the question from the standpoint of the economy. How is it contributing to this economy that I was describing, and what's its place with respect to the innovation engine? So here, we're trying to show you that that segment, artificial intelligence, is going like gangbusters. It's attracting the lion's share of all of the VC funding. And there you can see the growth rate. And look at it in 24. Extraordinary. I mean, that's just that's a quantum leap over the previous years. So VCs at least think there's really something here. Here's our share of investment. So take all the investment in AI across the entire country and look at us with an 80% share of it. So if it's happening, it's clearly happening here. We can say that. Here's how it's driving these other drivers. It's 11% of M&A deals. It's AI companies are 38% of those unicorns I was telling you about. 39% of startups now is claiming more than 2/3 of the startup funding. If you're wondering about our standing nationally with respect to other peer regions to whom we're connected, that's what it looks like. This is a chart measuring intensity, and we measure it in these 5 different ways. But by any of these measures, you can see that we have the biggest cluster, we have the most early adopters, we have the most federal funding, we're doing the most scientific research. All of this is true. These are some other indicators that tell us that Silicon Valley really does seem to have a leg up in all of these ways. I should mention that the investment in AI is not limited to venture capitalists alone. It also includes institutional investors. And here I'm talking about our big tech players who are also investing, not only in their own companies, but also in other companies who are doing this kind of work. And so we're pulling the lion's share of that activity as well. Okay, I think it would be great to invite somebody on stage who is a venture capitalist to talk to us. So I would like you to meet Emily Melton. She is the managing partner at Threshold. And Emily, it's great to see you. Thank you for joining us today. This is a microphone. That microphone.
I did not know I was standing. I'm super happy I'm wearing sneakers.
Yeah, we want you to be dressed comfortably. Definitely. I think you look terrific. Thank you. Thank you for coming. I'm a guy standing on the outside looking in. You're doing it. You're living this. Let's just ask you the question straight up. Is artificial intelligence the next big thing, or is there a lot of hype here? Let's start there.
Yes and yes.
Yeah.
Is this on? Can you guys hear me? No. So how do I turn it
Nope, they'll take it. Don't touch it. They'll take it. They've got you.
Well, I actually think I turned it on.
Yeah, good.
Yes, okay. See, technically savvy investor. Thank you guys so much for having me here today. It's an honor. I think with AI, you have to hold 2 things to be true, which is, it can be overhyped, and yet the profound implication can be much bigger than we even think. And I think that's actually where we are today. And sometimes I think you've done a really good job, I think, in this presentation, putting things in historical context. And I think that's really important. Like, our entire industry is predicated. This Silicon Valley is exuberance to swinging back to then taking more and more of the value, right? And I came to school here in the mid-90s, and you just think about, what companies were in the S&P, top 20. It was Microsoft in 2000, right? Fast forward to today, Microsoft's the only one that is still, that had maintained it. Everything else, Google, Meta, none of these companies even exist. Apple weren't there until, for 10, 15 years. So you see, the swings where you have that innovation, and then you slowly get the economic value. Netscape was in 1994, right? The iPhone was in 2007. So if you think about the context, ChatGPT came out 2 years ago. So what were we thinking about the internet in 1996? What were we thinking about cloud and the app ecosystem in 2009? So that's where I'd put us, right? I do think, the one thing I will say is I do think the innovation is going to happen much faster. I think the adoption cycles are going to be more profound. I also think that unlike those other 2 innovations where incumbents, Nokia was sitting on its back foot, no one else really understood the internet, the big companies aren't sitting on their back feet, right? The top technology companies are spending more on CapEx than oil and gas, right? So they're really recognizing that there's a big value at the end of the pie. But I still think we're very, very early on in the journey. So I'm very excited in the long run, but I think we have to be very cautious and thoughtful in the short term.
By the way, that big spike in 2021, I'm just curious your take on that. Was that just
Sure.
overexuberance?
I mean, look,
Or was
like,
that-
I
was
think
that
you
all
have to
credible?
take it in the big context, right?
Yep.
Interest rates were zero. So when you say venture capital, who were those venture capitalists,
Yes.
right? You also had huge hedge funds coming into the industry that were spending money, tons of money, which was a rational economic decision because they had to underwrite risk because they couldn't get returns elsewhere. And so I think your context is right. We're looking at like 2018, 2019, it was $140 billion of US and venture capital overall. 2021, it was crazy, right? And then it came crashing down. You had 350 at the peak overall in the US. Then it went down to 250. Then it went down to 170. Now we're back to 190, which, as you indicated, like, it's still above where we were. So it's hard for me working with my young founders because they're like, oh, it's all different. And you're like, no, it's actually back to reality, right? Those 3 years were the anomaly, not this, not the overall. We're back on the right cycle. You have to take those out. But for young investors, young founders, people who came out in that time, they think that's how it's supposed to be. But money is not supposed to be free. And risk capital is supposed to actually have trade-offs, and I think we're back to more of that rational trade-off.
I'm curious about something. Am I characterizing it correctly? There's more discipline being expected of startup companies, fiscal discipline. The old mantra was, we're in a race to be the next unicorn. So let's get there as fast as we can. Let's scale up. Let's hire people. It doesn't matter if we're profitable early on. Has that entire dynamic changed?
Yes, but again, I have to put it in the context of 3 years
Please.
or 4 years,
Please.
right?
Please.
Google was profitable a couple years after it was founded, right? Meta was actually driving, a lot of the best companies could actually tweak their profitability and were doing trade-offs of growth. So capital efficiency has usually been inherent in most technology startup companies. The entire thing of a startup, what is it, right? It's having a leverage via technology that can actually have you do something better, faster, and cheaper, right? So you should see that play out in the economic value. There was a period, again, when the risk capital came in, which everyone was grow at all costs, we need to hire, all of those things. And that did create some bad behavior, fiscal policy, but you were being rewarded to do it. If you didn't hire those people, if you didn't spend that money, your competitor would. And so you had to do it. You had to play the game that was on the field. I think you've seen that kind of pull back, but I wouldn't say it's abnormal, right? Every single financial investor is investing in something with the hope it could be public or be acquired, and that's a rational base off of future cash flows. So if you're not making money, right, you're not going to be able to be a good business. I would say one of the things that's a little bit, I'd say the outliers, and that's where all your AI dollars are.
Yep.
There's AI, like big models, right, where you're building, and then there's AI like the wrappers or application layer. And you are seeing behavior where we are funding to the tune of billions and billions of dollars these models that are going to have substantial losses for a period of time. And I think that's still TBD in terms of how that overall plays out, in terms of how many of those companies can sustain themselves, especially when they're competing with the likes of the balance sheets of most of the big tech companies. But most of the other AI companies that are actually leveraging, the big thing was like DeepSeek, right? It wasn't just $6 million, but you have a Chinese company that say, we did the same thing as these Silicon Valley businesses that raised billions of dollars, and we only did it with $6 million. Even if it's off by an order of magnitude, say it's 60 or 600, still very small relative to what we're spending. That was bad for you had the day where what are we doing? But for all the other startup companies, they're like, I can just get access to these great models at even cheaper. That means I'm gonna be able to do more things. And I'm gonna be able to build more applications. So overall, that innovation is good. And I think that's gonna drive a lot of companies, but I'm really cautious. I think it's still very early on to see who's actually gonna extract the most value when you're spending billions and billions of dollars competing with the likes of the big tech companies.
I want to pose a question to you, see if I can characterize this. It is possible today to have a startup company using AI tools that make it unnecessary to actually hire people. And we're seeing a new trend. Startup company, hugely successful, but 20 people. Yes. And it will only be 20 people because you have tools that have eliminated the kinds of things that used to be human. So this gets to our population trends and also our workforce trends, and I'm wondering if that's the wave of the future, what we should expect. It also gets to one other thing. which is, it's very striking to see 20 people, realizing amazing gains at the liquidity event. Those gains used to be held or shared by 100 people or 500 people. Now, 20 people, right? And so that gets to another trend that we'll be talking about in the second briefing. But anyway, are we characterizing that correctly? Is that happening at scale?
I don't know if it's happening at scale yet, but it definitely has the possibility to do that, right? We are seeing startup companies with tens of employees get to 100 million of ARR faster than we've ever seen, right?
Yeah.
And so I don't necessarily, we haven't yet seen the big outcomes, like OpenAI is still employing a lot of people, Anthropic is still employing a lot of people, but you are seeing a lot of these companies that are able to actually get this early product market fit. I don't zoom out, which is I kind of look at it as three kind of groups of companies. We have the companies that are publicly held or old business that you have this really hard time. Change management is really difficult. And re-underwriting your business, particularly if you have to answer to investors on a quarterly basis, is really hard. But it is fundamentally changing. A lot of our private businesses, even business at scales, hundreds of millions of dollars, are actually because they are private, are able to look at and go, we have to retool our business. Do I need to hire an SDR, or now I can actually use these tools to do it? Do I need to actually hire engineers, or are we going to be able to use these coding tools to actually build it? So we're seeing right now reforecasting broadly across most of our private companies that are trying to think about how to do that change management, which will drive efficiencies. But that's still a retrofit. For most of those companies, that is a retrofit, but it's a good one because it's going to drive efficiencies. Then there's a business you talk about, the yet net new companies that are starting right now that are only leveraging AI tools.
Yes.
And we're in the early stages of those.
Yep.
And I've also, you zoom out and you wonder, okay, so if if everyone doesn't hire an SDR and everyone's using agents to call and sell products, and then I set up a agent on the other side to answer all the emails and shit I'm getting and calls, are they just going to talk to each other and no one's ever going to sell anything? I don't know how that actually plays out. So I think there's a lot of things where there is efficiency. Where are you seeing the best, right? You're seeing the best in coding. Why? No surprise. A computer program language is really easy for a computer to learn, right? And so with that stuff, they can adopt really quickly and drive. I think some of the humanistic components ones, where everyone's like, AI is going to replace everyone, I'm a little bit more cautious. I don't necessarily believe. I spend a lot of time at the intersection of healthcare and AI, and I've been on panels where I've had billionaires who are much more successful than I am tell me multiple times that we're going to replace all doctors. I don't buy that. I believe that what I do think is you're going to have doctors that are retired or doctors that are actually working and leveraging AI. I do not think you're going to be able to be effective without leveraging those tools because they are going to make you better because they're forced on you. But I don't think that I think there are certain industries where you're not going to fully replace the human component. If anything, the ability to be human is going to actually increase in value.
Ladies and gentlemen, Emily Melton, please thank Emily. Yeah. So insightful, thank you. We're grateful to you. Yeah. I would love for Emily to stay on stage for the rest of the morning. This is really interesting. But let's cover one final subject before we go to a break, and we want to get one other expert on stage as well. The workplace is changing, you know that, and it's changing because of working from home. So just understand, I won't go into this in elaborate detail. We like working at home. We like to work in our pajamas. That's what all the data says. It's all perfectly clear. We're going to keep doing this, and it has and we're doing it at higher rates than our counterpart regions, metro regions across the United States. Okay, that's a fact. The question is, and what is it doing? One question is, are people actually working outside the region but holding the Silicon Valley job? They're remote but holding the job. The highest percentage that ever reached was 18%. That's the best we can explain. And we seem to have leveled out around 9%. So let's call it 10. 10% of our workforce, they don't live here, but they're filling a Silicon Valley job. It's driving a lot of this, and we're seeing it throughout the region. And so it means that we're looking at a restructuring. We're also looking at new opportunities, and we'll get some expert opinion on that. These are the vacancy rates. Again, I won't belabor this, but just so you know, in Silicon Valley, the vacancy rate is around 20%. That's a very high number. We haven't seen a high number like that since the dot-com completely imploded on us. So there it is, 20%. It's higher in San Francisco, 36% vacancy, and that's office I'm talking about. There are other kinds of commercial property, but that's what it looks like across the place. San Francisco has taken a hard hit, and I just want to say San Francisco is a great city, and they will recover. They are recovering. I also want to say, in San Francisco's defense, it's not only San Francisco, it's not only San Jose. These are national trends. Retail establishments, other kinds of establishments are closing and moving to other places because our patterns have changed and the dynamics have changed, and so this is happening. The corresponding decline in rents that people are asking hasn't kicked in yet. We can get expert opinion on that, but it's been about 7%. So you're paying 7% less on the marketplace now for that office property. I suspect that will fall even further. Today, as of right now, there's 8 million square feet of office space under development. That is a small number. That's a very small number for this region. A lot of the commercial space is occupied by our tech titans. They were expanding like crazy, and then the pandemic ended all of that. They're holding on to their leases, but they're not expanding on any of them, and they're not entering into new leasing activity. And so that's what it looks like across our big companies. Okay, I wanted to be really quick over all of that because I'm anxious for you to meet Joe Kelly, the Vice Chairman at Newmark. Joe, thank you for joining us. It's so nice to have you on our stage.
Good morning.
I appreciate this. Okay, again, I'm outside describing observable phenomenon, but you're on the inside. You're doing this, feeling this, living this, and experiencing the pain that it has brought your industry. What does it look like from your vantage? Is the sky falling?
Good question.
Yeah.
In some cases, yes.
Mm-hmm.
So we have a lot of office product that is not occupied, and costs have risen so much for tenant improvements, for office improvements. The price of office buildings has fallen so much that they now basically, you can buy an office building for the same price that you can improve an office building. So values are really, with debt being very expensive, office investors, for the most part, have gone away from the market. So it's left a lot of opportunity for people who are from the area, so to speak, who see value in office, but in general, national trends, office is pulled away from the investor base.
Yeah, interesting. By the way, we have a pop quiz, and you can take this on your Slido. What costs more, a vacant office building or a vacant warehouse building? And you're going to reveal the answer.
Sure.
Right?
Now, this is kind of a fun question, but in some cases, unfortunately, it's a vacant warehouse building. So in a couple years from now, that won't be the case, but there's been a lot of sales lately where office buildings, the hopes of new tenants expanding haven't been there. That's changed with AI. There's a lot of young AI companies. We could point to them and call them out by name. So that trend is changing, but strangely, a vacant warehouse building has been more expensive. Think of your local Amazon package, Probably half the room has ordered something since we've been in here that will be home. So that's why the warehouse demand is there.
Here's an ironic question. Do you work from home?
I do not.
You do not. And does Newmark work from home? Is that
Newmark,
an option?
I would say, sure. I mean, we're 100% commission-based agents, so it's, in general, this is our business. We like being in the office. Later today, I'm going to go buy a property that one of my clients owns, so that's our business, is driving the streets, noticing trends, showing buildings. So,
okay, but as guys with pencils, working on spreadsheets, trying to figure out what work from home actually means for your industry, how do you size it up? Is this the new normal?
I think it's kind of ebbing back towards, to me, the way I view it is, Jamie Dimon had some really aggressive comments in the press about JP Morgan's program working from home. I think the employer is starting to have a little more power in the form that the employee can't call the shots like they did through the pandemic. So I think it's starting to be balanced out. I think there is a place, work from home, remote work, there's definitely a place for it. It benefits families. It gives flexibility for individuals. I think we're kind of heading back towards productivity. And in some cases, it's going to be tremendous for the office industry. It's going to take a little while, but we're heading back that way.
Now, we have data that shows that San Jose's downtown has actually made a pretty impressive recovery. Do you see that?
I see it starting. It's a multi-year process.
Yeah.
We have seen it recover faster in other areas, Santana Row and Santa Clara Square in
Oh my gosh,
particular.
yes. Yeah,
Those
yeah.
two areas.
It's an exciting place. People love to be there.
And I think downtown San Jose can learn things
Yeah.
from those trends and the
Yes.
positivity that's through those
Yes.
areas.
But there's also conversions going on. This notion that vacant properties can be used for another purpose, like entertainment or housing.
Sure.
And what about that? Can you talk to us about the potential represented by converting commercial space to residential housing?
Sure. I think housing, I've learned this over my time now in the business, housing is so critical to these tech companies being able to grow and reoccupy office buildings, et cetera. If the housing's not here, the jobs won't come. So I think the Sobrato organization, I've heard John Michael Sobrato speak about this for 15 years, and it kind of just clicked recently. So, I mean, truly, the learnings from this panel and the joint venture, I think that's such a key to this region. So if we could create more housing. Now, converting old office buildings to housing, the Sobrato organization, again, has studied this, and they have the capabilities, and in almost every case, I believe their findings, and they could speak for themselves, was it's too expensive. Like, it's just, you're better off starting from scratch.
And can you explain why?
The location of the cores
Yes.
is one reason.
Yep.
Needing outdoor space for every unit is another. So essentially needing to add balconies so we can all have a little balcony to go out and get some fresh air. So there's lots of elements. So hopefully the cities and governments can find a way to give enough incentive that the price points or lowering fees or there's some movement, change in policy that creates an opportunity for more housing to exist. We're in these down periods of economy. It's so important that schools, healthcare, the businesses that basically have trouble competing in the hottest times in the market. So when the tech companies are ripping and taking million-foot campuses, it's harder for the other side of the economy essentially to take space. So today is the best time for these other uses to really find a home and find a place to grow longer term. So we've seen that in the last couple months, in last year, and hopefully there's more of that to come.
Can we thank Joe Kelly, our guest? Thank you. So nice to have your insight on the stage. Thank you. Thank you for that. We've reached our appointed time. It's now time to take a break.